Now, let's talk about why Section 280E is outdated. And Section 280E is outdated now because the sale of cannabis is a legal business in the United States. Cannabis businesses in any medical or adult use market must adhere to Section 280E no matter what. And as a result, these businesses may only deduct their costs of goods sold as a business expense. Now, costs of goods sold includes seeds, soil, water, nutrients, and expenses related to the cultivation and harvesting of the plant. But Section 280E does not significantly affect cultivators because the overwhelming majority of their business expenses do fall under cost of goods sold. However, that's only part of the industry. Costs associated with the distribution, the sale, the administration, the management, promotion, advertisement, and overhead and support are not allowable business deductions, which is the other 95% of the industry. Now, these costs include rent, employee salaries, shipping, contractors, legal fees, management, accounting. I mean, basically everything under the sun. Utilities like electricity, internet, phone services, health insurance, rent, overhead, and compliance. For most companies, a large percentage of the overall costs do not fall into cost of goods sold. So for most companies, almost 95% of their costs of their business are not going to be deductible. Now, paying taxes on gross receipts creates a significant tax burden, which in many cases can make a company unprofitable. Without these deductions available, legal cannabis business owners must pay taxes on all of their revenue without deducting business expenses to reduce their taxable income. State legal cannabis business owners are being unfairly treated compared to any other business, legal or illegal, because cannabis business owners cannot deduct business expenses, thus, as I said, paying taxes on gross receipts rather than net income. Now, here's the kicker. By disallowing cannabis businesses owners the opportunity to deduct business expenses, the Internal Revenue Code converts an income tax into a gross receipts tax. Now, this tax rate is effectively 70% or higher compared to the average tax rate of 21%. Here's the conclusion. Congress punishes cannabis business owners who try to comply with the law while creating a competitive advantage for black market dealers that Section 280E was actually enacted to punish. Section 280E is now punishing legitimate businesses, which is not the intent of Section 280E. Looking back at the legislative record suggests that 280E was enacted to punish illegal drug dealers, not legal businesses. Today, the distinction between legal cannabis businesses and illegal drug trafficking is material. The former distributes lab-tested medicine to patients, while the latter sells unregulated substances to consumers who could be underage. Now, since the enactment of Section 280E, the federal government's opinion on cannabis businesses evolved to a more accepting perspective, and the opinion of cannabis at the global level has changed. Countries such as Germany, Italy, Mexico, Switzerland, Australia, Argentina, and the United Kingdom have all legalized cannabis as a medicine. In 2018, Canada became the first G5 country to legalize adult use at the federal level. In January of 2019, the World Health Organization proposed rescheduling cannabis within international law because the current classification of cannabis is not consistent with the research showing the medicinal benefits of the plant. Now, despite the slow and gradual implementation of legal cannabis programs, cannabis companies are quickly becoming global players. For example, one Canadian cannabis company, Aurora, operates in 24 countries. U.S. consumer spending on legal cannabis reached over $10 billion in 2018. Now, even if no other states reformed their laws, cannabis spending is expected to top $26 billion by 2025. In late 2018, a Gallup poll showed 2/3 of Americans supported the legalization of cannabis in some form. This momentum underscores the immediate need to reform Section 280E to fully realize the potential for cannabis in the United States economy. The legal cannabis industry is scaling, and Section 280E does not fit within what the U.S. and global markets have become. Now, looking back, when Congress passed Section 280E into law, no state in 1982 had enacted legislation legalizing any form of cannabis. To Congress's credit, actually, in 1982, Congress did not suspect legal drug trafficking would be one day a viable business model. In 2019, with 33 states and DC now, having hosted or a medicinal or adult use cannabis market, Section 280E is now being applied to legal businesses, that is, state legal, more often than it is to the types of illegal drug dealers the drafters intended to penalize. Although Schedule 1 and 2 substances might make up the greater majority of the illegal drug trade, Section 280E does not apply to drug traffickers who sell Schedule 3, Schedule 4, or Schedule 5 substances. As applied in today's market, Section 280E contradicts itself. The goal of Section 280E was to punish illegal drug traffickers, not legal businesses. The legislative record points to illegal drug traffickers as the targets of 280E. But today, the IRS is applying 280E to cannabis businesses in states that have legalized the market in some form. Why? Because cannabis is still a Schedule 1 substance under federal law. Now, while some states legalize cannabis for medicinal or adult use, federal law still considers the plant illegal, which means the IRS can continue and does continue to impose Section 280E on legal businesses that, quote, traffic the plant while they file their federal income tax, or when they file it. As a result, state legal cannabis businesses are struggling to survive because they have virtually no ability to deduct business expenses compared to other businesses, remember, legal or illegal, who are able to deduct rent on business property, salaries and wages, advertising, licensing fees, repairs, and legal fees. With state markets online and operating, and Congress allowing the markets to grow without worry of federal prosecution by the DOJ, Section 280E remains an obstacle for state cannabis businesses because it denies state legal cannabis business owners any deduction for any business expense except for cost of goods sold. Now, despite the change in law that we see almost every election cycle at the state level, federal law has not changed, but this podcast episode proposes the need to.